So I think that this is a story worth following. But Bill Ackman's SPAC has officially signed a really I think this is a really big deal in clearly a market that is going to remain relevant, I suspect, for at the very least the rest of our lifetimes.
Yeah, I mean, not only a very relevant deal, but it's a very complex one.
Yeah.
I think actually it was so complex that the title of our last episode on Industry Focus was a very complex SPAC deal when we discussed this. So we learned a little bit more over the weekend about this. Bill Ackman tweeted out at a little after 1:00. He tweeted out "Happy Father's Day," and then a few minutes at 2:00 he tweeted out an updated press release that said the deal had been finalized. So if you, it's not long enough of a show for me to go through the complex deal again, go through all the new points. But there's 3 points to the deal, so I want to briefly just kind of discuss the new stuff we learned, if that's okay, and see what Jason has to say about this.
Sure.
So first, the Universal music business in general, which is not taking up all of the SPAC's money, but is the primary focus of the deal. They're buying the 10% stake. They're going to distribute those shares to investors. We already knew all that. We got a few more details about Universal's business. According to the press release, Universal has a 32% share of the worldwide music market. That's pretty big. About a third of the music market is Universal. They have all of the top 10 artists in the world. All 10 are Universal recording artists.
Wow.
That's so not only is it a valuable business that's generating revenue, they're building up some of the most valuable intellectual property in the industry. They've grown revenue at about a 10% annual rate recently. It was down to 5% last year because of COVID, which is to be expected. The music business just wasn't having a good year, and a year where no one could go do anything.
Yeah.
And the business is running at a pretty impressive 19% operating margin. The bottom line operating margin, 19%. That's pretty impressive.
Particularly when you look at the economics of the music business, generally speaking. I mean, it is a business, it seems, fraught with red tape. But then also, I think probably most investors out there, when they think about the music business, they're thinking about Spotify, right? Or Apple Music. And really, I mean, Spotify and Apple Music are the ones that are licensing that music from Universal, aren't they?
Yeah, and this is like, Universal's considered like a legacy player, and that's the kind of margin like a tech company would like to get.
Sure.
Roughly 20% operating, bottom line operating margin. That's pretty impressive for any company.
Sure.
So that's what we learned about Universal. That's the big part of the deal money wise. Then you have the remaining SPAC. Pershing Square Tontine Holdings is still going to be trading under PSTH. We had a few new details about that. Ackman gave a lot of new details about what happens with the warrants. Remember, all SPACs were issued with warrants as well.
Yeah.
So he gave us some color on those. A lot of it, that was a big unanswered question from the original press release. Sometime after the deal starts going, they're going to have a warrant exchange period where current warrant holders can just exchange their warrants for a certain amount of shares. There's a whole table that kind of says what the exchange is going to be. And kind of the Tontine part of it means kind of like a community aspect to this. Ackman wants us to be like the most shareholder friendly SPAC. So when the SPAC, the shares originally came with, or the units of the SPAC originally came with 1/3 of a warrant. Only 1/9 of a warrant was distributed to shareholders. The other 2/9 is still attached to those shares and is only given to people who hold through the business combination, kind of as an incentive to not sell.
I like that.
So, right. So those are called the Tontine warrants in the presentation.
That does sound like a Star Wars sequel or something. I'm just saying.
Yes, it does. On. So for every 9 shares you own, you'll get 2 of those Tontine warrants upon the business combination. They will be adjusted in price because about 3/4 of the SPAC's assets are going to buy the Universal stake. So the remaining shares will be worth like $5.
Right.
I think it was $5.50 or so is going to be remaining in asset value. So the exercise price will be adjusted downwards. It will no longer be a SPAC, which means now they have a total of almost $3 billion to find another business acquisition, which Ackman specifically said it's going to be an acquisition, not something like the Universal deal where they're buying a stake. He
So
said they
full
want
on acquisition,
so a
buying the whole
full-on
thing.
SPAC acquisition.
Gotcha. Okay.
But it's no longer a SPAC now because it already completed a business. It did the Universal deal,
Yeah.
which means that they no longer have that 2-year time frame working against them.
Huh.
So they have a $3 billion war chest, and they can kind of pick and choose their spot as to, they can work on whatever timeline works best for their shareholders, which is nice. So that's what we learned about the remaining assets. Oh, and immediately after that, they're going to undergo a 4-for-1 reverse split, or a 1-for-4 reverse split.
Huh.
Because, like I said, there's going to be their shares are going to be like $5 after Universal comes out.
Right.
So he wants to bring it up to a $22 net asset value per share in the remaining SPAC.
Wow.
So
that is just an interesting. I mean, like, it does go to show you, and I always I always like to say this, but investing it's as easy or as difficult as you want to make it. It does feel like that's a pretty complicated pretty complicated sort of process that this has been going through.
And we're not done yet.
Okay, we'll go on.
So that was part 2 of the 3. Then you have the SPARC, which is like the new SPAC.
That's right.
I discussed what the SPARC was. Essentially, it's a blank check company that's not raising any money initially. They don't raise money until they actually find an acquisition target. So you don't, it's kind of a cross between a SPAC and the traditional IPO. And by the time they're raising money, investors know what they're buying.
Right.
So everyone who owns, for every share of Pershing Square Tontine Holdings you own, you'll get one of these SPARC warrants that will allow you to participate in whatever the eventual business combination is at an exercise price of $20. So this SPARC will have up to $10.6 billion, which is a lot more than Pershing Square Tontine had even, to pursue a mega acquisition. And they have a 10-year time frame, which is a big competitive advantage over a SPAC.
Absolutely.
If one of these big companies says, we're not quite ready to go public yet, but give us 5 years, Ackman can wait for that. Other SPACs can't.
Yeah.
That's a big competitive advantage here. So everyone's getting one of these warrants, which I think is probably the most underappreciated part of this transaction. The Universal part alone is worth about what the shares are trading for today.
Right.
Then you're getting that remaining part of the company. Then you're getting that SPARC warrant, which the Pershing Square Tontine SPAC warrants trade for like $7 right now. And they have a higher $23 exercise price. They're about to be forced to be exercised. So these could be worth more than that. And you're getting one for every share you own.
Wow.
So it's I like the value in this deal a lot. I have actually increased my position since they announced it. And now, because I know what the deal is, and I'd call this a lot more of a value investment than a growth investment, especially Universal's a big established company. The SPARC warrants are very investor friendly. So I would actually call this a lot more of a value investment than a growth investment at this point. I actually bought some in my retirement account.